Economy Series 4, Snapshot of RBI Part 2. Which acts are administered by the RBI? Reserve Bank of India Act 1934, Public Debt Act 1944, or Government Securities Act 2006. Government Securities Regulations 2007, Banking Regulation Act 1949, Foreign Exchange Management Act 1999, Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, Chapter 2, Credit Information Companies Regulation Act 2005, Payment and Settlement System Act 2007, Payment and Settlement System Act 2007 as amended up to 2019, Payment and Settlement System Regulation 2008 as amended up to 2022, Factoring Regulation Act 2011. What initiatives have been taken by RBI? Recently, the Reserve Bank of India Governor inaugurated the Reserve Bank Innovation Hub, that is the RBIH, in Bengaluru. It has been set up as a Section 8 company under the Companies Act 2013 to create an ecosystem that focuses on promoting access to financial services and products for the low-income population in the country. It is a wholly owned subsidiary of the RBI. More recently, RBI has put in place a mechanism to facilitate international trade in rupees, that is INR, with immediate effect. As per the broad framework for cross-border trade transaction in INR under Foreign Exchange Management Act 1999, FEMA, all exports and imports under this arrangement may be denominated and invoiced in rupees, INR, and the exchange rate between the currencies of the two trading partner countries may be market determined. How independently does the RBI function? Under Section 7 of the RBI Act, the central government may from time to time give such directions to the RBI as it may, after consultation with the governor of the bank, consider it necessary in the public interest. Moreover, there is no legal act mandating autonomy of the RBI. Yet RBI has always been looked upon as an autonomous body which has under its umbrella all commercial banks, be it PSBs or private banks or foreign banks. It is not only vested with the powers to formulate the monetary policy, but also to monitor the functioning of all banks. To play its role effectively, autonomy in its functioning is sine qua non for RBI. However, the independence of RBI has been challenged many times due to a continued tug-of-war for wresting more power between the bank and the government. The main reasons for this have been RBI's failure to check the growth of non-performing assets, reduced liquidity in the economy due to tight monetary policy followed by RBI, corrective measures taken by RBI to clean up the banking system which are not seen very positively by the government, clash between short-term populist agenda of the government and long-term view for the price stability taken by RBI. Regulation of public sector banks. One important limitation is that the Reserve Bank is statutorily limited in undertaking the full scope of actions against public sector banks, PSBs, such as asset divestiture, replacement of management and board, license revocation, and resolution actions such as mergers or sales, all of which it can and does deploy effectively in case of private banks. Erosion of statutory powers of the central bank through piecemeal legislative amendments that directly or indirectly eat at separation of the central bank from the government. Why in the news? The Reserve Bank of India has released the Composite Financial Inclusion Index, that is the FI Index, for the year ended 31st March 2022. What are the findings? India's Financial Inclusion Index has improved to 56.4 from 53.9 in the previous year 2021. The improvement has been seen across all its sub-indices: access, usage, and equality. What is the Financial Inclusion Index? It is a comprehensive index incorporating details of banking, investments, insurance, postal, as well as the pension sector in consultation with the government and respective sectoral regulators. It was developed by the RBI in 2021 without any base year and is published in July every year. Aim: to capture the extent of financial inclusion across the country, the FI Index is responsive to ease of access, availability and usage of services and quality of services consisting of 97 indicators. Parameters: it captures information on various aspects of financial inclusions in a single value ranging between 0 and 100, where 0 represents complete financial exclusion and 100 indicates full financial inclusion. It comprises 3 broad parameters. Weights indicate in brackets access 35%, usage 45%, and quality 20%, with each of these consisting of various dimensions which are computed based on a number of indicators. The index is responsive to ease of access, availability and usage of services and quality of services for all 97 indicators. What is the significance of FI Index? Measures level of inclusion. It provides information on the level of financial inclusion and measures financial services for use in internal policy making. Development indicators. It can be used directly as a composite measure in development indicators. Fulfill the G20 indicators. It enables fulfillment of G20 financial inclusion indicators requirements. The G20 indicators assess the state of financial inclusion and digital financial services nationally and globally. Facilitate researchers. It also facilitates researchers to study the impact of financial inclusion and other macroeconomic variables. What is financial inclusion? Financial inclusion is defined as the process of ensuring access to financial services and timely and adequately credit when needed by vulnerable groups such as weaker sections and low-income groups at an affordable cost. In a diverse country like India, financial inclusion is a critical part of the development process. Since independence, the combined efforts of successive governments, regulatory institutions, and civil society have helped in increasing the financial inclusion net in the country. Being able to have access to a transaction account is a first step towards broader financial inclusion. Since a transaction account allows people to store money and send and receive payments, a transaction account serves as a gateway to other financial services. What are the initiatives to increase financial inclusion in India? Pradhan Mantri Jan Dhan Yojana, Digital Identity, that is your Aadhaar, National Center for Financial Education, that is NCFE, Center for Financial Literacy, that is CFL project, expansion of financial services in rural and semi-urban areas, promotion of digital payments.